Right, good afternoon, everyone, and thanks for joining in our strategy building session this evening. Okay, so what we need to do is we obviously need to, kind of look at the different types of approaches that we can take in terms of putting together our own strategies. Now, what I want to do is I want to run you guys through a couple of basics first, I would say. Okay, to give you more or less an idea of how we're going to look at the different components that are needed for a strategy and how each one fits into place. I almost want to get you guys to the point of being able to spot quickly where issues within a particular system is. Great stuff seeing you on, Bevan. Welcome and that kind of thing. If there's any questions that pop up, by all means, just use the group chat feature and so forth, and we'll just run through it. So let's get started then. And what we're going to do is I'm just going to set this back quickly so that we kind of look at the different things that are utilized within building a strategy. Okay. So now what we're going to do now is we're just going to look at the different components that are needed. And there's three things that are needed whenever we're going to put any type of strategy together. The first thing is we need what we call entry conditions. Okay, now entry conditions would be any condition, okay, that needs to be met in order for you to open the trade, to enter it. And that's it. Now, the other part, there's three parts. The other part is exit conditions. So remember, we've got entry conditions, what's needed in order to open the trade. Exit conditions is everything that needs to happen or confirm in order for us to close the trade. So we've got an entry mechanism and we've got an exit mechanism. Those are the basic components that forms any strategy. But then there's a third one as well, and that is the trade management system. That would include anything that needs to happen or needs to be checked while the trade is open. Okay. These three things will have to be known before you even enter the trade. Now remember, whenever you're going to start building any new strategy or system, you're never going to know beforehand whether the system's going to be a winner or whether it's going to be a huge profit producer or anything like that. None of that's going to be available to us until we actually sit down and do a back test. Okay, so best thing probably is to come up with a couple of ideas that you can play around with, get a feel for it, and from that point then what you want to do is you want to kind of see what happens more or less chart wise. Okay, almost get a bigger picture and get an understanding of how the system flows. Now you're going to need to know obviously what times you're going to be trading, what chart times you're going to be focusing on, and those different types of things. And you should already have a very good idea of what your time availability is like. Now remember, if you're going to want to trade intraday, you are going to want to target any market opening because that's where the movement happens. At the end of a session like that, you're not really going to get anything happening. That's why normally in the evenings the markets are quite dead, because we're basically at the end of the US session and the Asian session only starts around about 2 a.m. in the morning, South African time. So you're going to notice it's a very, very dead type of session, and there's not going to be a lot of movement. So making money in those sessions aren't that good. It might be a better idea to look at something like end of day trading then, or you could even trade 1 hour charts. This means you only need to look at the chart once every hour in order to spot your entries. And if you're going to be managing a system as well, that's what's going to help you a lot as well. Being able to only need to check the chart once an hour. So you need to find that niche for yourself. and kind of get an idea of what would be good for you to target. Now, if there's going to be anything that's going to interfere with your trading, then that's not really, going to fit good for you. To give you an idea, let's say you want to trade 9 to 12 like I do. You're going to need that space open for yourself. You don't want any interruptions. There's nothing worse than getting into a trade and then all of a sudden you need to go and do something else, and now you can't manage your system. You can't move the stop if that is part of your system. Okay, you're basically taking all the power of your system away. So what you need to think of is, if you're going to utilize a system, you need to be able to replicate it 100% the exact same way as you tested it. Now, at this point in time, we're not really going to know what the results are or anything like that. We're just trying to come up with ideas in terms of putting a system together. So, like I said, we're looking at the three different components at this point in time. Remember, what we're looking at is we need something, firstly, what tells us to get into the trade. Then we need something to get us to get out of the trade. And trade management tells us what needs to happen while the trade is still open. Okay, and we're also going to make a note of things like stop loss management, our risk to reward perimeters, and all those different little things. Now, one thing that you're going to notice is that your system is going to be written incorrectly once you get to any point of confusion within your backtesting. That's the clearest giveaway that your system is written incorrectly. So what we need to do is we need to look at how do we write or develop a strategy in the correct format. Okay, now the big trick in building any strategy, guys, is to have something that is easy, firstly, to execute for yourself, to follow as well, and to manage. Remember, you need to think about the different little components that could interfere within your trading and find a way either around that or to remove it from your trading session. If you can't, it might be a better idea to look at a different type of trading session. Maybe target higher time frames or target a completely different time in the day. Remember, there's two times we can tackle in the day, basically, when it comes to 15 or 5-minute trading. You can basically do 9 to 5, but 9 to 12 is the first busy period for the morning sessions, and then we've got the afternoon sessions, which runs from 3 till 6. And that's the US session. Okay. Now, the big problem that most of us face is to make sure that we stick to our strategy. So, okay, what we're going to do now is we're going to look at the specific way in which we at DGV Investment Group write our strategies. And we conform to what we call the tick chart method. And this method is going to be a must whenever you put any system together. Okay, because the beautiful thing about this system is it helps you to stick to your rules of entry and exit and so forth. It eliminates the doubt because you need to tick off each condition as it's happening. And only once all your conditions are met can you actually enter the trade. If none of them are met, well, no trade. It's also going to help you to trade very consistently, and it's going to help you keep a track of each trade perfectly. And that's why I say this method, or this tick chart method, needs to be followed from this point onwards always. Now, first things first, we're going to look at the first section, our entry conditions. Now, there's two types of entries that we can take. First one is obviously buy entries, and then we've got sell entries. And you see I've split them into two. Okay, a category for buys and a category for sells. Now they're going to have the exact same conditions, but they need to be met differently. So obviously for anything happening on the buy side, we're going to be looking at bullish charts, right, with the trend. And on the sell side, it needs to be bearish, but it's the same indicator we're going to use, no matter what we choose. Now, what I want to know from you guys at this point in time now, okay, seeing as we've got all of you on here, what are the two main ingredients we need in order to spot an entry on a chart. Okay, there's two things we need to look for. Okay, what's the first thing? Who knows? Let's see. Who can get this? Beautiful, Colin. That's exactly it. We're looking for trend first. So our first condition will always be built off of a trending indicator or anything that can identify the trend. Okay. So the second thing we're going to need then is, let's see who gets this. That's it. Well done, Colin. Spot on. We need any type of entry signal that is generated. And normally, what we tend to use is we tend to use our leading indicators to identify timing of our entries. Okay? And we're going to use that with the trend then. So this already explains, all in all, what you're going to need for your entry conditions. Now, this means basically that we need two types of indicators. We're normally going to be looking at a trending type of indicator, or in other words, we're going to be looking at a, let's see who remembers, almost, Colin. It's the lagging indicator. Okay, so our trend identifiers are what we call lagging indicators. And then we'll use the leading indicators for the entries themselves, because they run slightly faster. Now, when you're trading on one time frame, this is normally the perfect type of setup to go for. Now, what you might find sometimes is that the indicators don't sync up that well. So you might be getting buy signals when you find that the trend is bearish, or you might find it happening vice versa as well. And if that happens bulk of the time, then it basically means that the system is slightly out of sync. And this can happen. This happens often, especially when you're using two time frames. Okay. So what we tend to do is, let's say we're going to use two time frames. Remember, that's what we call multi-time frame analysis. So it always has to happen in multiples of either 3, 4, 5, or 6 times the size of our trading time. So if you're going to choose to trade 15-minute charts, then your options for using a larger time frame to base the trend off of would be a 1-hour chart, because it's 4 times the size of 15 minutes. Okay. So when you're going to be using multi-time frame analysis, two time frames, a larger time frame for overall direction and then a smaller time frame for entry, you might find that you're going to get this contradiction in terms of trend and your entry signals. If that happens, the best tip I can give you guys is to actually turn your trend indicator from a lagging indicator to a leading indicator. Now let's give you an idea or an example. The MACD histogram, okay, whenever it's above the naught line, that's bullish. And whenever it's below the naught line, it's bearish. That is what we use the MACD for, to identify trend or direction with. But if that's too slow, and if you find that it doesn't sink in, then what we actually do is we speed up the MACD by using it as a leading indicator. And what we do with that then is we just simply use a signal line cross to identify bullish and bearish sections now. This means that you are going to get your trend changes happening a lot quicker, and you can catch those signals a little bit more in sync. It's just playing around with it slightly until you see that, okay, now it looks like it's syncing up nicely, and so then you might have something that you can work with. Okay? But when you're normally trading one time frame only, so you're using, let's say, a 15-minute chart for trend and direction, we tend to stick to lagging for trend and leading for entry. Does that make sense, guys? Okay. So normally one time frame, it's going to be lagging for trend and leading for entry. When we're going to be looking at 2 time frames, we can find sometimes that they do run out of sync. That is where it would work better to use leading on the larger time frame for trend, and then leading as the entry indicator on the smaller time frame as well. Let me give you guys a tip. This is exactly what I do with my stochastic setup. I actually use the stochastic on the 15-minute for direction. So when it starts pointing up, I'm looking for buy signals, and I time my 5-minute stochastic to give me a buy signal then as well. So I trade the momentum of both time frames going into the same direction. So that's why I can use then a leading indicator to actually identify trend with. So you can see that these conditions are quite open with one another. It's just playing around with quite a couple of options. Okay, so that's the whole process in putting together your first set of conditions, your entry conditions. Okay, split it into 2 sections. We're going to have conditions for a buy, and then we're going to have conditions for a sell. Now, as you can see here, our first condition, this will always be the direction indicator. Okay, in other words, our trending indicator. The second one would be entry into that direction. So let's say I'm using a MACD and a stochastic. Right? The MACD I'd use then for the lagging indication, histogram crosses the north line. Okay, and I would be looking for a bullish cross happening. Now here's the thing. I'm not going to wait for just the bullish cross. I would trade any signal that comes up for a buy, right, on my second condition, whenever the MACD is deemed to be bullish. So as long as the MACD is above the north line, it will be considered bullish. So I don't have to wait for that cross to happen. As long as it's above the north line, I'm happy. But it has to be confirmed. So you can't do it on the first one. It's always going to be on the second signal onwards, or the second bar onwards, because then that direction change has been confirmed. Okay. The third one here is what I say, we tend to call that an extra condition that needs to be met. Now, something like that could be, you might use the ADX as just a further little confirmation to tell you that, you might stay out if the trend is not intact. In other words, let's say the ADX is below 20. If it's above 20, then all of those signals apply. So that's like a final little filter that you can add in. We're normally always going to start off with 2. Once you start backtesting, you might find that you might add a third little one in there to keep you out of some false movers. That third little condition for me on my stochastic setup is that 8 moving average. Okay? And it just helps filter out false signals. So that's normally what that third condition is there for. It's that final type of filter that we use for our normal signals in the first 2 conditions. Okay. And trust me, guys, you can actually add even more, but it gets slightly more complicated once you start adding even more than that. Okay. But I'll show you guys as we go on how we tend to go about that. So that's normally what you'd be looking at when trying to put any system together. We focus on entry conditions first. Okay, so we need to know what we're going to get, what we're going to use to get into that trade. We're just going to split them up as buy conditions and sell conditions. Okay, so obviously the buy conditions will just be the vice versa of the sell conditions, and that is it. Now, most of the times only 2 conditions would be used. Okay, and as you progress with the building of your strategy, and you start backtesting, you might then add another condition on top of those 2. Okay, right, now, are there any questions that you guys have got at this point in time before I move on to the next slide? Okay, so far it looks all good then. Right, next slide. Now we're looking at the exit conditions. This is the second part of a system that needs to be built. Now remember, Our exit conditions can have as many conditions as we want. But here's the thing, whenever you're going to start putting any system together, I want you guys to only start with two. It's either the target or the stop. That's it. Okay? Nothing more than that. The rest will be brought on as additional closing requirements that you find during your backtest. So we're just going to start with running off with the normal stop and target placement. That's the only thing that is going to get us to climb out of those trades. Okay? And we're going to do a normal backtest and see whether it produces profits or not. Once we've seen and we've checked our backtesting, then we can check, would it maybe produce better results to actually add in, let's say, a change of trend? Okay, would get us to stop trading or climb out of any open entry. So let's say the trend was bullish, we climbed in a couple of buy trades, and let's say half an hour later, we see that the signal changes and it starts showing on the indicator that it's turning bearish. And once it's confirmed to be bearish, then we would close any open current trades. That's an extra closing condition, but we only tend to bring those in play after our original backtest. So you will only start with two exit conditions always. You start with a target and the stop being your first two conditions. The rest only comes on as an addition once you start with your backtesting and you've done your first backtest. Okay. Third one and last component is what we call a trade management system. Now remember, here we're going to make a note of the rest of the body of the system. So here we have to make a note of the type of stop loss placement we're going to identify. Now here's the thing. It's going to be useless to say I'm going to be using a stop loss to get out, but I don't know where I'm going to place the stop. Okay. If you're going to tell me, okay, stop will be placed at the most recent high or low, what's the problem with that wording? Okay, because now we're going to start looking at wording as well. What's the problem that we've got with using that wording that stop loss is placed at most recent high or low? That's it, exactly, Colin. How many candles is that going to go back? The thing is that what you'd find most of the time, and you've probably seen it happen already, is that sometimes you're looking to get into an entry, but it's difficult to actually know which one is the most recent high or low, because they're either very close to one another, or it seems like it could be a lot further back. This is why I like to tie a set amount of candles to identify these stop loss placements with as well, because that never changes. And this is the thing now. Now it's not something that is subjective, something that you need to kind of guess for yourself. It's set in stone. So this can be tested over and over and over. And if you're going to be hit with the same type of flow on another chart, you won't necessarily pop the stop loss on a separate place. So remember, we need to be very, very specific in our placement of the stop loss. So our wording for stop loss placement has to be very, very specific. I always suggest that you guys use the following wording. Stop loss will be placed at the most recent high or low within 7 candles. Now, why do I use 7? Well, 7 has got a nice flow of it, and you can always kind of set your stop loss to be maybe less after the original test. So what happens if you set your stop loss to the most recent high or low within 5 candles, or maybe 3, or maybe 4? You see, you can even push it up higher or further if you want to. But normally what we tend to do is 7 is I find it to be more of a magic number almost. Okay. Now, that's one of the major things that you're going to need to remember in describing your trade management system. So we need to know how we're going to place our stop loss and where. Once we know that, then it's going to be easy to identify the target. And the target is going to be very simple. We're just going to run that with a risk to reward system. Always start off with using a risk to reward of 2 to 1. That's it. Nothing more, nothing less. Now, why am I saying this? If you don't set something in terms of your risk to reward, how do you know you're going to place your target? Not only that, more importantly, all we want to do with our first strategy is to get something that we can start backtesting with. That's it. Never ever start feeling despondent when you do a backtest and it doesn't look like the system is going to produce profits. That's not the end of the world. Because here's the thing. All we do with the first test is to identify where the weak points in the system is. That's it. That's really what that first backtest is for. So you can come up with any type of system that you want to. I really don't care. Right? This is the beauty of it. All we do is, this is why we run with these first sets of perimeters first. Remember? Stop and target is the only exit mechanism we're going to use. And then stop loss placement in the trade management section is stop loss is placed at most recent high and low within 7 candles. And then our risk to reward will be 2 to 1. This gives us a good starting point to work off of. We would be able then, once we start with the backtest, to spot how often do we get stopped out. How often does price get close to the target and then turn and stop us out? Would it maybe work better to use a smaller target? Or would it work better to use a tighter stop? These are all of the little things that we can look at applying then. Those little extras that you've been taught, within the video sessions, tweaks basically that we're going to make to try and push up the profits and make the system a lot more profitable, or start turning it into a profitable system if it isn't showing profits. Okay, so remember, the chances of you putting a system together and finding something that actually produces profits, guys, it's highly unlikely. Okay, at a particular point you might start gaining a type of intuition into a particular chart's flow. So it's going to be a bit easier to start putting something together the first time that actually produces profits. But this is going to take a bit of time. This is why I'd rather have you guys start off with a set principle, and from there you've got something that you can gauge the next tweaks that you're going to make on. So you'd be able to see, if I maybe shorten the stop, will it actually increase profits or not? Because remember, the main thing we're concerned about is profits. It's not about how often we are correct, but how much money we're going to make. That's the key factor. You might find that removing the target makes a lot more money, but now you need to manage the stop loss. And how are you going to manage that? Right? All these are extra little tweaks that we're going to start bringing in after our first backtest. And even with the tweaks, you need to be specific. So if you're going to say that your stop loss will be ratcheted after you've done your original backtest, what is that telling me? Okay, I'm setting a condition that my stop loss is going to be ratcheted. What's the problem with that? If I give you a brand new trading strategy to run with, and all I say is that you're trading with an open target and you have to manage your stop loss by ratcheting it, what are we missing? The question is, how do we manage it? With what do we manage it? Okay. Now, okay, Colin, you're saying ratcheting the stop loss, yeah. The point is how exactly are we going to ratchet it? And this is the thing. You need to come up with something that's going to be concrete, that's going to be set in stone almost. Now, I'm going to give you guys a couple of ideas here, okay, that you might be able to use within building your own systems and so forth. Um, okay, and exactly, Paul, good mention on that as well. Remember, when we're going to use an open target, we're never really going to know what the risk to reward is. You're going to need to make a note, though, of what you're going to be risking per trade in your trade management if you're going to use an open target. So we'll always use a risk of 1%. But now we never know what our final reward is going to be because of this management of the stop that's going to happen now. So what we need to do is to give you guys maybe a couple ideas. I might say that I'm going to be ratcheting my stop loss with something like a moving average. But now I need to make it clear what type of moving average. Is it going to be a 10 moving average, an 8 moving average? When do I close it? As soon as the moving average is touched, or as soon as I get a close to the other side of the moving average? You see, those are the different things that remain open with just saying, like we see here, right? Stop will be ratcheted with the moving average. Okay, so we need to be a little bit more clearer. So I might say stop loss will be ratcheted with a 10 moving average. Okay, and basically what happens is trade will be closed as soon as the moving average is touched. Because remember, if I'm going to ratchet it with a moving average, whenever it touches it, it's going to close it. Okay, but now we know exactly what's going to happen, and now we know what exactly we need to look out for when we're going to have to mark the trade as being closed out or stopped out. Another little thing that we can use, and here's the beautiful thing, you can use any indicator to tell you to move the stop with. So moving averages is a nice one. Parabolic SAR is a nice one. You could even use something like an ATR. You could even go with something like just using only the Kijun Sen. Okay, you basically use the Ichimoku then, but all you do is you make sure that the Ichimoku is set to the same background color as the chart itself, with everything else except the Kijun line. That means you only have the Kijun line running on your chart. So you can manage your stop loss with other indicators, but you need to be specific with the setting of the indicators that's going to be used as well. Because if you don't set that in, then it's open-ended. I mean, it could be a 50 moving average, a 2 moving average, a 5 moving average. Okay. Another thing that I like to do or use as well is saying that I'm going to make sure that the stop loss is ratcheted so that it is always at least 4 candles back from the current candle. So once the chart starts moving into my direction, the stop loss gets ratcheted and it makes sure that it's always 4 candles back. But you see, I've set a set number to it now, so there's no guessing. I'll always know that it's going to be 4 candles. I could change that maybe and say, let's make it just 3 candles. Maybe just 1 candle back. That's the thing. We're going to need to play around with those settings within our backtesting to know which of those is actually going to be the more profitable ratcheting method. Okay. So you can see that when you're going to look at adding a tweak like ratcheting the stop, we need to be extremely precise as to how we will ratchet it. Because if it's not stated there, then that thing can be ratcheted anyway. But what does that mean? You're going to have to guess every single time when you want to take a trade, or once you've entered the trade and it starts moving in your favor, what are you going to use? You don't have anything clear or concrete set in stone. And this means it's open-ended and it leaves you open for doubt, which means you're going to be left open for making big errors within your trading. And the emotional side is going to take over then very quickly and easily. Okay. Right. We'll also make a notice of the settings that we're going to be using on the indicators, for our entry conditions and the exit conditions and so forth. And those are the main things that we look at in terms of putting any strategy together. We have to be very precise with the wording. Okay. So what I want you guys to kind of look at in a while, before we get there, let's just run through this. Now, okay, this framework should be followed from now on every single time. Okay, there's no questioning this. You need to run with this every single time. Okay, this is going to force you to stick with your strategy's rules and conditions every single time you take a trade as well. Thus, this is going to make sure that you don't fall prey to emotional involvement. Now, you can add your trading diary entries to a sheet for this as well. Now, normally what I recommend with the tick chart method is once you've written it out and you've typed it out, okay, I want clear tick boxes that you've seen before. Let's just go back to that so that you guys can see what I mean. These tick boxes, okay, I want to see that because you need to physically tick these things off, okay, and normally what I recommend is you just type it out in a Word document. You get this little tick boxes in there, and then you actually print that sheet and laminate it. But that's once you've finalized your strategy, okay, and you've tested and you've found that it worked. I'd literally want you to just laminate that sheet. You stick it right on top of your trading desk, and then all you do is you use a Koki marker or something, right? Or whiteboard marker that you can easily, clear off of that page. Once it's laminated, you can use that page over and over and over. All it does is it makes sure that you guys maintain that habit of discipline. That is why I'm always going to be so anal in the way in which you write your strategies. If your strategy is not written in the correct way, I'll tell you straight. Okay, and I'll tell you where the problematic areas are and that kind of thing. But I need you guys to start seeing and understanding for yourself how we'd be able to spot what are the problematic areas. It's going to take a little bit of practice, but that's the thing. The more you practice this, the better you get at it. Okay? Right. Basically, this is all you're going to need in order to have someone else trade your system for you. That's the beautiful part of it. Okay. Remember what I said, in some of the webinar sessions, that kind of thing. What you want is you want to be able to put a system together, and with the way that you've worded it, you should be able to give that system to any stranger, give them access to your account, and have them trade it the exact same way that you would. Okay. If you can't get that done, then you know that your system's wording is problematic, and we might need to fix that. Yeah. Right. Devil, good to see you on. I'm just going to mute your mic. If there's any questions, that kind of thing, just use the group chat feature. Okay, and that's at the top left of the Hangout section. Great to see you here. Right. Now, what we're going to be looking at is I want you guys to see how we can get more intrinsic almost with putting together a strategy. Now, what happens is sometimes certain clients have more than one type of entry conditions. This is almost like merging two separate strategies together. So what we might have, and we might have a layout like this then, where we've got our first two conditions, which is the direction and entry conditions. And then we set a little section which is or. So we either get the first two ticked or the next two ticked. Okay, so the next two would either be the same or completely new direction indicator that needs to be met. And then we'd normally have a new entry condition that needs to be met, or cycle that needs to happen. Okay. That is how we actually merge more than one system together on the same tick chart. Now, the wording of your conditions are extremely important, as I've just hammered on that now for quite a little while. Okay. The fact is that any ambiguity that you're going to find within your conditions, they're going to wreak havoc within your trading. If any of your conditions are open-ended, it means you've got to guess. And as soon as you've got to guess what needs to happen, doubt sets in. And once doubt sets in, forget about it. Okay? Remember, like I always say, whenever in doubt, stay out of the trade. Okay? So make sure you are precise with your conditions, and there needs to be no room left for anybody to have to interpret what it's supposed to say. It needs to say exactly what needs to happen. This just eliminates any confusion that you're going to have when using multiple entry method strategies. Okay, right. Now, what I want you guys to kind of do for me is let's look, okay, we've got about 20 minutes still. So, and remember, for those of you who did show up late, by all means, all you have to do is you could just go back and check the replay, okay, and follow it again. But what I want to do now is I want to look at having us set up a basic strategy at this point in time. Okay, so let's just kind of fling a couple of things together. Remember, there's three parts of a strategy, right? So let's get the pen set. Okay, so we've got entry conditions. So we're normally going to have conditions for buy. And then we're going to have conditions for sell. So normally we're going to have two tick boxes. First one's direction, second one is entry into the direction, same as for the sell. Okay. Now what I want you guys to do is start thinking of direction indicators. Okay. And remember, we need to be specific with the wording as to exactly what confirms the direction or the trend. Okay. Next one we've got is obviously our exit conditions. We will always start off with only two. And I'll get you guys to complete that for me in a minute. And then what I'm going to do, so that's number one. Whoops. Okay, and that's going to be number two. Okay. And then over here, we're just going to set number three, which is trade management. So I'm just going to call that TM. It's not trademark, it's trade management. Okay. Right. Now, first things first, let's check with you guys if you remember what I've just mentioned now. Okay. How's it, William? Great to see you on. Okay. Right. Within exit conditions, we're always going to start off with using only two conditions for exit. What is that? What are they? Let's hear it. This is whenever you put any new system together. That's it, Paul. Well done. Nice one, Bevan. Exactly. So we're just going to write now. Okay. Exit condition is obviously when stop is hit. And then when target is hit. There we go. Okay. That's always what we're going to start off with. Okay. So that's exit conditions done. Nothing more needs to be done. We'll only change on that if need be once we've finished with our first backtest. Okay. Trade management. What do we need to make a note of here? What is going to be filled in our trade management section? Let's see who remembers. It's two things that I always need you guys to start off with within your trade management. That's it, Bevan. Where we're going to place the stop, and then our risk to reward ratio. So let's look at risk to reward ratio first. What is the risk reward ratio that we're going to use always when starting off? That's it, 2 to 1. You will always start off with your risk to reward ratio being 2 to 1. Okay. Now, stop loss placement. What wording are we always going to use or start off with on our first strategy or any new strategy that we build? Let's see who remembers. I've only said it like 15 minutes ago, guys. Come on. Someone must know. What type of stop loss placement are we going to use in the beginning of any new strategy that we're going to build? There's a specific wording that I'm looking for. Let me help you guys start it off. Okay. Stop loss is placed at That's it, Bevan. Well done. Nice one, Colin. Exactly. Okay. At the most recent high or low, and here's the important thing, within 7. And now I'm just going to make a little addition here. The 7 is going to become a variable after your first backtest. So you can change that up. But we always start off with 7 candles. Okay. So these are going to be basically the set blueprints that you will always start off with when building any new strategy. The only reason we're going to run with it this way when starting off is to make sure that we've got something that we can base the next results or compare the next tests or tweaks that we're going to make according to. Okay, so I need obviously a set of results for my backtest first. This is what's going to produce it. Whatever you use for entry, I do not care. Okay, I really don't care. You can use anything. Okay, but you will stick with the set exit conditions that I've given you now, and you will stick with the set trade management that I've given you now as well. Okay, on your first system test always. That is just going to give you the groundwork that is needed in order to know whether any change or any tweak that you're going to bring in is going to be more profitable or not. Okay. Right. So now let's get a bit more, I want to say, let's get a bit more exotic now. Let's look at our entry conditions. Okay. Now, I want to hear from you guys. And we're actually going to use what we're building here now. We're going to use within a backtesting session as well. Okay, so let's come up with something that we're going to use, okay, for direction. Now, here's the thing. Let's look at using one time frame and one time frame only. I want you guys to pick a time frame quickly. What time frame are we going to trade? Okay, 15 minutes, that's what we're going to use. Thanks, Colin. Okay, so we are going to be using 15-minute candles to trade off of. Okay, now I'm looking for a direction indicator. Okay, I'm looking for something now that's going to help us to determine trend breadth. What are we going to use? Let's hear it. Anything, anything. Whatever it is, I do not care. First one that comes up is what I'm going to use. Okay, MACD. What are we going to use the MACD then, Colin? Okay, we're not at the entry indicator yet. Okay, so we're going to use the MACD for direction. But what are we going to use? I can't just say direction or MACD is going to be used. The MACD's got, remember, there's actually 4 different ways of interpreting the MACD. Okay, well done. That's it, Colin. That's exactly what I'm looking for. So we're going to be looking at when the MACD histogram changes with the naught level. So now you've given me the bullish condition. Great stuff. So by when MACD yeah, okay, let's actually remove that and let me show you the wording I'm going to use now. Okay, so MACD histogram is above naught line. Done. Okay, then obviously at the sell, it's just going to be the opposite. So it's MACD histogram is below naught line. There we go. Done. Okay, that's our directional indicator done. Okay, now lucky packet prize for entry signal. Any indicator other than the stochastic at this point in time? Let's hear it. Who's going to be first? And you can see now why it is so important to know the different types of signals that each indicator gives. Because you need to know that in order to build systems. So remember, learning your indicators really, really well is extremely important. That's where you're probably going to put most of your time into in the beginning, and understanding when they signal different types of entries, when they signal bullish or bearish, those different types of things. Can no one come up with any other indicator? Come on, guys, there's hundreds more. Okay, there we go. RSI, thank you. Right. Almost full. Almost. It's just a couple of seconds after Colin there. We're going to go with the RSI then. Okay. Right. Now, um, who wants to give me the wording we're going to use for buy entry on the RSI? Okay, there we go. Thanks, Colin. Right. So, RSI needs to, whoops, close. Yep, there we go. From below oops, from below to above, obviously. To above the 30 level. There we go. Okay, this means it needs to confirm then, okay, being above 30 from below. Why can't I just use the RSI needs to be above 30? See, the important wording that you got correct, Colin, was using exactly, Colin. That's the reason. It's not showing or it doesn't show any specific direction or give any specific direction. And not only that, with the wording just saying the RSI needs to be above 30, it means I could take the trade whether it's at 50 or whether it's at 80 or whether it's at 33 or wherever it is, whether it's pointing up or down. At any point in time above 30, I could take the trade. That's why we need to be more specific. And that's why using the crosses section that you did using the wording there, right, is perfect. It gives clear and concise understanding of exactly what we're waiting for. Do you guys start to see now the way in which we need to word these systems and why it's important to word them correctly? It just removes any of the confusion out of your trading. So obviously then for the bottom one, it's just going to be RSI needs to close. Now I'm just using the close wording, but the cross wording is perfectly fine because it clearly states that it's coming from the other side going to the other side. Okay. I'm just saying closes from above now to below what level? 70. Okay. Now here's a little trick. We don't have to stick with the 30 or 70. We can make it 25 and 75. We can even make it 20 and 80 if you want to. You can even make it 40, 60 if you want to. Okay, it's personal opinion. But at that point, we always tend to start off with the 30 and 70. So you could tweak that maybe in your second back test. Normally what works best is to give a quick glance after your first back test on your chart to get an idea of exactly what the best type of, I would say, a tweak could be from this point onwards. Okay, if you find that you don't get the RSI may be hitting below the 30 enough times to give you that entry signals for the buys, then you might need to just lift it slightly more. Okay, if you see that it is kind of giving too much noise, then you might want to raise it slightly more. Okay, you might speed up the RSI and instead of using a 14 RSI, you might use a 10 RSI or an 8 RSI. It's all just playing around and finding a good flow almost within what it generates with the chart itself as well. That's just playing around a little while. Okay, so never choose anything set in the beginning. Just play around and get an idea, and then once, remember, the most important parts is basically making sure that you stick to your trade management with these wordings in the beginning, and then also with your exit condition by only using those two. The rest, I don't care how you go about it. You can play around with it as much as you want to, but on your first strategy build, you will always keep the exit conditions and the trade management as is. Only after your first test will those change. Okay, this just helps us start with a grading mechanism, having enough data to grade any of the changes we make against, because we need to know whether those changes are going to be profitable or not. So if it isn't profitable, we leave it. Check the next tweak. Does that make the profits better? If it does, we keep it. That's how we go about it. It's basically a process of elimination as we go along. Okay, we just check and see, does this create better results or not? Yes or no. If yes, we keep it. If no, we go on to the next one. Okay, and that's it. That's the process of putting together a system. Just remember that we always start off with exit conditions only having the stop and target in place, and trade management with the risk to reward of 2-to-1, and then the wording for the stop loss being placed at the most recent high or low within 7 candles. After the first backtest, we play around with those settings and see what would happen if we change any of those. Okay, and that should give you guys a much better understanding and idea of exactly how we go about in putting our systems together. Right, now we're basically at the end of the session, right? We're going to start in half an hour with our backtesting session. I'm going to use this in the example, okay? The strategy that we just put together. Just want to find out from you guys, are there any questions at this point in time before we go offline? Okay, great stuff, great stuff. Okay, it looks like everyone's good then at this point in time. We'll just give it another minute. Okay, looks like everyone's good. Okay, right. That's it for then now, guys. Okay, so remember, for those of you who did join up late, guys, all you need to do is you could just use the normal registration link that I sent through earlier today, and you can actually go and check the replay of this afterwards. Okay, I'm just going to start setting up for the next webinar, which starts at 6:30. That's where we're going to be looking at back testing this strategy that we've just built. Okay, so I'll see most of you probably in about half an hour. Okay, I'll send you the Hangouts link very shortly. Okay, right, guys. Cheers, and until a couple of minutes later.